Hey y'all, some big news coming out of yesterday. I know it's unfortunate. I know it's definitely not what you envisioned for your senior year. But like I said, sometimes there's circumstances that you can't change and you can't control. This is one of those. All I can tell you is I'm sorry, and a lot of opportunity comes out of hard times. I know it's uncertain. I know it's new, it's untreaded waters, but I really think you guys are gonna have a great opportunity coming out of this. So try to maintain that hope, man. Try to maintain positive attitudes, and I know it's not perfect, but it's gonna work out. Everyone's gonna be on the same page with these kind of things, and going to try to make the most of it. With that being said, we only have 3 weeks of actual content left in econ, so we'll try to make the most of it. I always try to leave a couple weeks at the end of the year to try to have some buffer time, some time to really focus on yourself and focus on your final preparations before what would be graduation or at least the end of schooling for you. So let's get there safe, let's get there in one piece, and let's break it down here. For this week, we're talking about the Federal Reserve System. This is something that's very relevant, especially in recent times, i.e., really the Trump administration has discussed the Fed a lot. And then, especially now, with times such as the economic hardship and the uniqueness of this situation, the Fed plays a huge role, and it's important to understand what the Fed is because it's not actually the government, but it works hand in hand with the government. So we'll understand the history and the structure of the Fed, and then we'll talk about what the Fed does to kind of promote the economic well-being of people. Now, a lot of this is background and history, so I'll try to be quick because I know you know how to read, but there's certain points that I really want to drive home on. So the Fed is the central bank of the US, but just like many branches of anything in the US, it's subject to a system of checks and balances. So there's 7 board members consisting of the governing body. They, as a group, elect someone to be the chair of the Federal Reserve. They serve for 4 years. Our current chair is Jerome Powell. Each Federal Reserve bank, it has 12 districts, so it's in control of 12 different sections of the country. As you can see, New Jersey, is actually cut in half between two. Your assignment this week is going to ask you to tell me which one we belong to, so I'll pump the brakes on that. But look at Bank 12, San Francisco. Look at that region they control. So it's not about the population size per se. It's just the way that it unfurled through history. Now, the Fed has something called the FOMC, the Federal Open Market Committee. This is basically an economic roundtable where each of the 12 banks, they kind of come together and say, all right, San Francisco, how was your region? And Philadelphia, how was your region? St. Louis, how was your region? And by dividing these responsibilities, they come together and discuss, okay, based on what we've said from around the country, what economic predictions or statuses can we draw out of the economic data? Of course, the history of this, we've had many banks throughout history. I taught most of you in US 1, so I don't have to go too far in the detail, but what is good to know is that really it was right around the turn of the century, 1913-ish, is where we really begin to see the origins of the Federal Reserve that we know it nowadays. President Woodrow Wilson, just before entrance into World War I, decided that a centralized bank is what is required to be successful as a country. Now, because of the Great Depression, shout out to my boy FDR, we learned that some archaic views of the economy have to be let go. So laissez-faire, this idea of hands off and the economy will fix itself, that sounds really good until stuff hits the fan, and then it doesn't work out the way they seem. The view on prices, in old times, they used to believe that only inflation was bad, but we now know that deflation is bad as well. We look for price stability. And then, of course, the gold standard. One of the most common misconceptions in the modern world is that we're still on the gold standard. We are not. Nothing backs our money. We are on fiat money. There is no gold in a safe anywhere backing up the US dollar. Because of acts like the National Banking Act, we learned to move forward without these standards. We learned to trust the system and the financial institutions in place. So, what the Fed actually does. For one, they distribute currency in the US. Now, note, they are not the mint, right? They're responsible for the distribution of the money that is printed by the mint. So they control the money supply. In addition, they function as the overseer of the automated clearinghouse. So if you ever heard someone say like they're going to wire money, that wiring of money is actually the electronic transfer of money. And in any form that happens, it is monitored and safeguarded by the Federal Reserve. The Fed wire, so the Fed being kind of the major institution of American money, they have the ability to send money to any other reserve bank, but also any private bank or institution. So let's say you had to perhaps withdraw a large sum of money from a bank that didn't have it. The Fed could immediately wire those funds and they could issue an electronic transfer because of it. And then, of course, they act as the government's fiscal agent. So they maintain the bank accounts for the Treasury and for tax deposits and things like that. Now, of course, they are the overseer of all banks in America. In addition, they review the bank's charters. It's almost like an audit in a way. They're allowed to look into what things the bank holds as collateral and their capital requirements. So they kind of are a big brother in terms of all banks in the country. They enforce all types of laws. If you've seen any of these ones here on the right when you're applying for either a home loan, an auto loan, or even financial loans of any kind, these things have to be disclosed at all times, and this is part of the Fed's role. They make sure that fair practices are taking place in terms of loans. And then, of course, they supervise some of the largest firms in America. So in a way, they are a watchdog group. Now, monetary policy is really the big thing. It's truly the nuts and bolts of what the Fed does. So at the Federal Open Market Committee meetings, they sit down every 6 weeks and they discuss economic conditions. They look to stabilize prices and then, of course, take care of the other economic indicators we've talked about. Now, how they do it, and this is the big one right here, they have several tools at play that they can use to manipulate the markets. Open market operations are what it calls when we buy and sell treasury bonds, right? So if the Fed is selling what we call securities, you can think of them as bonds, the Fed is selling bonds, which means that people can buy those bonds. And when that happens, the Fed gives them, metaphorically, a slip of paper that says you own a bond. And in exchange, the Fed takes people's money in. So they reduce the money supply by selling bonds. And then, of course, conversely, if they wanted to pump money back into the world, they would buy back those bonds. So let's say you had a bond at $100 and the Fed really wanted to increase money supply. They would make an offer to you. They say, hey, we're going to give you 110 for this and we're going to take it back. That way, they're pumping money into the markets. The discount rate, this is the rate that the Fed loans money to the private banks. So when you go for an auto loan and you see it's 3.5% APR, well, that bank most likely borrowed the money from the Fed at the discount rate of, let's say, 3%, right? So by manipulating the discount rate, it affects the rate that we see as consumers in the real world. If they increase the discount rate, that means that it costs more money to borrow, and therefore money supply will end up decreasing, and of course, vice versa. Reserve requirements. You'll remember last week we talked about the money multiplier and how banks only have to keep a small percentage of the money on hand, the rest gets loaned out. Well, the Fed can manipulate reserve requirements to either open up more money or to restrict how much money is being out there in the world. And then, of course, interest on reserves. And the last final tool for it, the interest earned from deposits with the Fed. This works kind of like the discount rate, but again, just another means of manipulating the money supply and how much is actually out there. So with that being said, that's the big role of the Fed. They are the big brother bank. They're the ones that kind of keep a check on every other bank in America. And as much as you may hate or love the decisions they make, especially if you follow politics, one thing is true, that we definitely need the Fed to help regulate everything else. Does the Federal Reserve always make the correct decision regarding monetary policy? Definitely not. But they do always at least have the best interests in mind, and they try to be that stabilizing vessel in our economy. Your activity for this week is pretty straightforward. I tried to keep it easy for you, so I'm not going to break it down on here. Other than that, I hope this helps. If you have any questions, classroom remind, email, whatever it is, please let me know. I'm happy to take care of you.